Brian, when it comes to passive real estate, I've heard this term called REIT, but the REIT comes in two different flavors. What are those?
Yeah, it's a real estate investment trust. So basically you're buying into a pool, usually a pool of real estate assets. So this is where, as opposed to being an active landlord where you buy a property and you're the property manager or hire somebody to be the property manager, this is a way that you can invest in real estate without getting your hands dirty and not getting a phone call, that kind of thing. So I've broken it down into private REITs and public REITs for a reason, kind of getting into the weeds a little bit here, but a publicly traded REIT, you can buy either an individual publicly traded REIT on the New York Stock Exchange or a mutual fund or an exchange traded fund of REITs. So let's say you did that, you just had some money and you say, you know, I want to own apartment buildings. Well, you can buy Avalon, or you can buy an apartment building REIT, and you will be a part owner in hundreds of apartment buildings, or industrial parks, or self-storage, or a mixture of all of the above. So there's different ways that you can buy, and it's very easy to do. Now, conversely, you can do what's called a private non-traded REIT. And so generally they have net asset minimums. You have to have at least $300,000 of assets outside of your house, or you have to be an accredited investor, meaning $1 million of assets outside of your residence to even qualify to buy them. You have to go through a financial advisor to buy these. So they're a little bit different. So they're a little bit more limited on getting into them. They're generally smaller. Most of them are smaller. There's one that's huge, but most of them are smaller. But they're more targeted. So I did want to spend a little bit of time talking about some of the pros and cons of each.
Okay, so publicly traded REIT is sort of like a stock. I mean, you can buy it on an exchange, you can buy it and sell it easily, as opposed to a privately traded REIT. What is the advantage of a private REIT over a public REIT?
Yeah, the advantage of a private REIT over a public REIT is that you can more specifically target, as I mentioned, exactly what you want to get into. Maybe you want to target single-family residences. You want to own those, but you don't want to be the landlord. And so you might buy a REIT that has 20,000 of them in it. Or you want to target self-storage, or you want to target data centers, or whatever it is, wireless communication. It could be anything. And so if you want to be specific in what you invest in, that would more likely afford you that opportunity. And so that would be an advantage. Another advantage of that is you might have higher returns because maybe better appreciation potential because you picked the right asset class, or better yields. Now, the advantage of a publicly traded REIT is that they're fully liquid. They're easy to buy and sell. Private REITs aren't so much. You might have a time period you have to hold it, and maybe you held it that time period and they've changed their mind and have closed it to new liquidation. So that can happen sometimes with a private non-traded REIT. So they're not as liquid as a publicly traded REIT. A disadvantage also of publicly traded REITs is that they are highly correlated to the stock market. I think that's a disadvantage. So let's say you bought a nice mix of real estate in a publicly traded REIT, and the market goes way down in value. You're saying, well, my real estate shouldn't have gone down, but it did. Why is that? Well, that's because there's about a 70% correlation between publicly traded REITs and the stock market. So as the stock market goes up, you'll benefit. As it goes down, you don't. And it's kind of driven by the value of the stock market to a big degree. So that's a concern. Sometimes that helps you, though. But that can be a concern of owning publicly traded REITs.
So both of these REITs are basically fractional ownership of real estate. And as you said, liquidity is something that you really need to be concerned with.
Absolutely. So you're spot on. They are fractional ownership in real estate. And so a lot of people like real estate. I mentioned it as one of the big 5 categories you can invest in: bonds, stocks, insurance company products, cash and cash equivalents, and real estate. But you may say, well, I'm not very handy with tools and I don't want to be a landlord. So now you start looking into, all right, I can buy a publicly traded REIT, no problem. There's no minimums there. I can do that all day long. So you can be a real estate investor with very little money. Or you can buy, if you have more money and you hit certain net worth categories, you can invest in the private non-traded REITs. Or you can do both. If you like real estate, maybe you want some that's liquid and you're okay with some being illiquid because you have a strong preference as to how that's invested. So you absolutely can mix and match.
Like any investment, you want to vet those. There are good ones and there are bad ones. How do you vet REITs?
Well, it's an art, not a science. So there's a lot that goes into it. You have to understand. That's one of the issues with some publicly traded REITs is that they often have been around a long time. Maybe they bought their properties a long time ago. And if you bought a publicly traded REIT that's been around a long time, maybe they own a lot of shopping malls or stuff that you say, well, I don't really want shopping malls or office buildings and hotels in the post-COVID world. Maybe that's something you want to avoid. And so you have to understand what kind of real estate they're in, the age of those properties, the cap rates, the net returns, cash flow on them, the fluctuation, volatility, and so forth. So there's a lot that goes into it. I wouldn't just throw a dart and hit the REIT board and just pick whatever it landed on. You want to put your research in.
Brian, thanks for telling us more about public and private REITs.